We're so excited here at International Budget Partnership to welcome both of you to discuss your tax transparency course. Please introduce yourselves and tell us a little bit about your backgrounds.
I'm Richard Murphy. When I was writing this course, I was Professor of Accounting Practice at Sheffield University Management School. I'm now Emeritus Professor of Accounting Practice at Sheffield University Management School.
Wonderful. Welcome, Richard. Andrew.
I'm Professor of International Political Economy at the University of Sheffield. I have a specialism in various aspects of economic governance, including international economic governance.
Richard, if you had to summarize all the different areas the video series covers, can you give us a breakdown of what they will learn?
Well, there are 32 videos, but we're talking about 5 hours of material here. The series does work step by step through what tax transparency is, how it can be created, what the benefits from it are, and then most particularly it talks about how this works with regard to particular situations. And that's by and large with regard to each type of tax, because some countries will put a focus on one sort of tax and not another because of their particular situations. And that's a very important point with regard to this series. We're not prescriptive. We don't presume that there's one right or wrong anywhere. We know that some countries will put a high emphasis, for example, on indirect taxes like VAT, value added tax, for example, and others might try to put an emphasis on corporation tax. So that's why we talk about those in detail and how to communicate around them. And then once we've been through particular taxes and have built this idea of tax transparency, then we talk about this process of accountability by government for what they've actually achieved and how that creates the need for further consultation and feedback with regard to planning, so that we integrate this into the budgeting and accounting process of government before we then move on to how to improve the system. The point is that this is a single narrative flow that will explain to you how you can do tax better. And that's what the whole idea is all about.
Let's go into the precursors to this course, talking about the previous work that was done, like making tax work, and if you could talk about GIFT and the GIFT principles and how that's included in this course.
Making tax work developed out of a piece of work that GIFT was then doing to try to understand the scale of the problem with regard to tax transparency and how civil society groups could be engaged in this and what it was required to make progress. But what was clear was that there was a need to explain the background to the problem, so that if somebody came to this afresh, there would be explanation as to how the tax system required transparency to function and where it fitted into the grand scheme of things. But the other key thing that came out of that was the experience of working on these issues at the interface between civil society groups and international negotiators who were trying to develop a better tax system, particularly at that time around the OECD, but also working with the United Nations, and bringing my experience as a professional accountant together to be sort of the bridge to try to find the way to make these things work. So making tax work tried to communicate just why these issues are really important as the foundation for the next stage, which was how to codify this into some principles that tax authorities in particular could try to apply.
The other thing that Making Tax Work did as well is it went through a series of mechanisms, procedures, and processes that governments could use to experiment with to try and enhance their tax transparency. At the end of that process, Richard and I identified what we saw as 10 overarching high-level principles of tax transparency that came out of that work. And then GIFT themselves developed 13 further principles. And that then commenced a round of consultation on the nature of those principles. Now, the background to all of this was that GIFT had been tasked by the World Bank Global Tax Program with bringing forward a set of principles on tax transparency for consideration that might become a benchmark for the international community. So this round of consultation took place. It involved the OECD governance team, and we got very extensive comments from them. We had verbal comments in session with various World Bank and IMF officials and IBP people. At sessions arranged by GIFT, we had commentary from South African Treasury and Revenue officials, from Filipino tax administrators, CSOs in several countries. Quite an exhaustive process. And I came up with the idea that really each principle needed a set of annotation notes to explain in greater detail how it might be applied in practice. So that's what we did. Those principles then went forward to the General Council of Gift Stewards on the 2nd of August 2022 in Bogota, and they were passed. The whole point about the principles was that they would become a resource for the international community. So the video series is in part intended to promote the use of the principles by governments, by tax officials, by national CSOs, and by international organizations so that they can assess how transparent tax policy, procedure, and process in countries around the world is.
Who would benefit from watching all of your videos?
Tax officials who want to think more systematically about tax transparency and what their own obligations may be. And they have incentives to do that. One, to obtain legitimacy gains, to show that they're essentially performing their job effectively, but also the possibility of increasing and enhancing their own resources to engage in evaluations of the tax system, how their own procedures are functioning. Politicians and government ministers might be looking to improve tax system performance. CSOs looking to ask governments to be more accountable in relation to tax policy, asking for more information to be made available on tax policy and tax administration. The kinds of things they could and should be asking governments to do in tax governance. The principles contain a sense of that, as does the video series. And then we've got international organizations in the sense that they engage in policy dialogue with national officials. It's important for them to be able to point to good international practice, things that might be done to increase transparency and therefore improve tax governance. And if international organizations can start to see governments or other actors in national systems beginning to use the principles to improve their performance on tax transparency, in particular locales, that's something that they can point to and encourage others to do likewise.
How do you define tax transparency as it's explored in the video course?
We define tax transparency as the qualitative and quantitative information interested parties need to be able to use to hold policymakers to account and assess how effectively a tax system was functioning. And that definition itself was, in a way, a significant departure because we weren't the first people to start talking about tax transparency. The notion of tax transparency previously had a footing in the international community, and it was generally associated with the work done on tax transparency by the OECD. And that definition or conception of tax transparency focused on information exchange between authorities to identify who pays tax where, and obligations on multinational companies to publish more extensive accounts than they previously had been. Those two things were strands and elements in our definition. But what we wanted to do was encourage people to think much more broadly about tax transparency and indicate that governments had responsibilities to be much more open about their own intentions, objectives, and to enable interested parties to reach judgments on how the tax system was functioning by publishing reliable, clear, high-quality information and data. And why that matters as a definition is it basically says government choices on tax governance and tax system design really count, but they need to make information available to enable others to reach judgments on how they're doing, but also to enable themselves to reflect on the impact and success of their own policies. Crucially, in this conception, and our conception in making tax work, is that tax is central to the social contract between citizens and the state. And tax transparency itself is a public good.
You were saying, Andrew, that tax is the center to the social contract. Can you talk about what that means?
The act of taxation fundamentally involves a government asking citizens connected and involved in various parts of economic activity to return some of the income and wealth that they generate, or at least have access to the government. And in return, the government delivers certain services hopefully manages the economy more effectively. That makes it really important that that process is seen by the majority of those actors within the system to be fundamentally fair, to have high degrees of integrity, to function effectively. Now, to enable all of that, you have to have flows of information, patterns of communication, mechanisms and processes that enable the various interested parties within the tax system to ensure that the government is indeed delivering a fair, inclusive tax system that has high levels of integrity, that follows due process. And one of the things that emerges very clearly, especially in academic and policy research on the idea of tax morale, which is people's willingness to pay tax, is that higher levels of tax transparency tend to bring greater degrees of tax morale, so greater willingness to pay tax. Richard and I's conception of tax morale, as we develop it in making tax works, goes slightly broader than that, because we don't just talk about willingness to pay tax as an individual transaction. We talk about faith and confidence and belief in the tax system as a whole, as an integrated entity. And that's a more encompassing and inclusive definition of tax morale. But it's really important because that's what cements the social contract. And the point behind all of this work is none of that can actually function, and tax itself can't work unless it's accompanied by high levels of transparency and the right types of transparency, and the right mechanisms are cultivated to enable and facilitate that transparency. And they're the basic ideas that fundamentally underpin the work that Richard and I have been doing.
When we talk about communication in the video series, this isn't just from the tax authority to the taxpayer, but we focus on the obligation of the tax authority to listen to the taxpayer, because this is a two-way process. I think one of the future directions of all concerned tax authorities to think about that communication process. This comes up in quite a number of videos because it's so important that we keep going back to it with regard to individual taxes and the process of tax legislation creation and so on. I don't think it can be said enough. Tax transparency is about communication. My great interest, the interest of political economists, is in relationships and how relationships change the allocation of resources within society. So we have a different focus in the way that we look as political economists to what economists do. Economists will make a set of assumptions and often assume, for example, that businesses profit maximize and people utility maximize and so on, and create econometric models these days as a result. Whereas we're much more interested in how system design facilitates or hinders the way in which a society can work to best effect. Now, both Andrew and I are interested in society working to best effect for everyone. And indeed, so was the World Bank when it introduced us, and so was Oxfam when they introduced us. So this is the start point that we come from. How can we create systems that work better so that we achieve outcomes for the benefit of society at large? What we've tried to do is develop that to the point where we're talking about how tax integrates everything within the thinking that a government has about how it's going to deliver its policies on inequality, how it's going to deliver its industrial strategy, how it might even influence its foreign policy. The point is, you can measure those impacts and you can understand that there is a consequence of tax in this sense. And it's this very broad understanding of the relationship between tax as probably the most powerful tool that any government has available to it to change the society for which it's responsible, that we use as the basis for our understanding of tax transparency and why we think tax transparency is so critical.
You created this 32 video course because there's a problem that needs to be solved. Can you give us an idea of how large the problem is?
There is literally no country that is doing tax transparency the way that we want. Not one on earth is actually reaching the gold standard that we set out in making tax work and then in the GIFT, Global Initiative for Fiscal Transparency Principles, which were the follow-up from that. And that's because we actually recognize that tax transparency is a process. And we highlighted that people can enter this process at a very low level, and they are what we call basic principles to start the process. And we end up with what we call aspirational principles, which is a tax spillover assessment.
Can you explain what tax spillovers are?
Tax spillovers, and this is a concept that we have really developed between us, were originally thought of as being an econometric measure, deeply mathematical measure of the harm that an external tax authority can cause to the internal tax authority of a country, basically a measure of the harm created by tax havens. And it was developed in that context by the International Monetary Fund. But there were major limitations with that work, largely because the data was so noisy that it was very hard to work out what the real harm being created for a country from a tax haven was, because there were so many other factors you could take into account as well. And we took that concept and turned it from being this rather econometric, numerical analysis into being a normative analysis where you assess the risk that exists to a tax system, both internally and externally, because it's quite possible for a tax system to undermine itself. Basically, it's a measure of how a tax system can create harm, but also how it can be actually synergistically good. In other words, how you can link everything together to achieve the common goals for the public good that a tax system can deliver if you get it right.
If you end
Sure.
up with a significant gap opening up between standard rates of income tax and rates of corporation tax, so that corporation tax is significantly lower than income tax, the notion of tax spillovers, as Richard and I have developed it, suggests that that builds a risk into the tax system whereby people and actors within the tax system start shifting money out of the income tax base and into corporate structures so they can avail of the lower rate of corporation tax. So in a way, the tax system, having a very low rate of corporation tax, can have a knock-on effect that undermines the income tax base. So we were seeking to try to get a handle on those kinds of things and capture those kinds of processes taking place within tax systems. So that would have been an example of a domestic spillover. But there can be international spillovers where very aggressive corporation tax regimes essentially lure revenue away from other countries potentially by those policies, in the sense that you get this phenomenon of brass plating occurring where companies begin to locate their head offices, or at least a major office in their operation in a particular locale, but very little actually takes place there. But the company has a registration there for tax purposes. And then one of the knock-on effects is it can deprive other countries of tax revenue, that kind of practice. So we set out to get a handle on that kind of thing by developing this notion of tax spillovers and trying to develop a tax evaluation framework.
Why should the creation of tax laws be integrated with the budget process?
As an accountant, I hate budgets that are just made up of numbers. Numbers are meaningless in themselves. Numbers have to always have narrative explanations. When you're talking about setting a budget, you have to understand what are the drivers of the information within that budget. And we talk about this quite a bit in making tax work, but also in the principles. Whenever, for example, governments talk about changes to tax legislation, they should be talking about what the impact on a budget will be. And that will mean who's going to pay, how much are they going to pay, at what rate are they going to pay, and so on. And that should be also integrated into the budgeting process, so that we should know if there is to be a value-added tax, how many businesses are going to be tasked with collecting this tax. In other words, how many are going to be registered, what rates they're going to have to apply it on, how often they're going to have to pay it, because in some countries that's every month, in some countries that's once a quarter. And all of those things need to be explained as the drivers of the budget process. And only when you understand that integration between the underlying law, the actual reality of what is happening on the ground, can you really create a budget that then produces meaningful information, which you can, of course, then compare with outcomes. You said you were going to collect tax from 17 million people, and it turned out you only collected tax from 12 million people. Where did the other 5 million people go? Did they just not declare? Is it just that the system can't identify who they are? You can then begin to ask all those big questions. And the reason for asking those big questions is the next budget will be better as a result of asking them.
Can you talk about how the design of tax systems either hurt or help inequality?
This is a massively important topic, and no country in the world gets this right. We know that the tax systems of many countries have within them incentives and allowances which are particularly designed to suit the interests of some people in those communities. And those people who have the power to influence the law tend to be the rich, the wealthy, the large companies, those with special interests. This is where we call for governments to actually have a strategic tax policy, a tax strategy. And the reason why we ask for that tax strategy is it creates the opportunity for dialogue. Because once we have a statement of intent, we can say, is that statement of intent justified or not? And then can we see whether that is carried through into practice? So if we have a government that says we're trying to create a totally progressive and equitable tax system, and then we find it is riddled with tax loopholes, then we can say, but it doesn't work, does it? Because of X, Y, and Z. Or if you say you have to create a favorable tax regime to keep the wealthy here, has that actually happened? And are you really collecting money from them? And does that really provide the benefit to society that you want? Now, these things are therefore really important at this very high level, because unless we have the dialogue at that very high level, we may not get the opportunity to discuss the detail of the policy itself.
The UK issues about 400 billion each year in exemptions, reliefs, holidays, foregone revenue, what's so-called tax expenditures. That's basically given away. And that's twice the annual budget of the UK's National Health Service. But we don't really know where this goes because there's very little detailed breakdown of how these reliefs are constructed and who's benefiting from them. But if you put that figure alongside another figure, which is that 81% of UK wealth is held in heavily tax incentivized assets, you can be pretty sure that a significant proportion of that 400 billion is essentially providing a subsidy to existing wealth. So this is one of the indirect ways that isn't fully appreciated because this data isn't in the public domain and this issue isn't being fully debated, in which the design of a tax system is probably amplifying inequality in quite a significant way. So the whole point about tax transparency and the tax transparency video series and the tax transparency principles is to call for more of this information to be in the public domain, to be made in accessible forms, to have some analysis and breakdown of where these reliefs are going and who's benefiting from them. And then we can have a political and societal debate.
Just a quick follow-up. So if they said that they were going to tax however many millions of people and they don't, what's the trickle-down effect of that?
If large numbers of people aren't paying the tax they're legally obliged to, then it contributes to what Richard has called a tax gap. The tax gap being the gap between potential revenue raised, sometimes even revenue that is expected to be raised, and actual income that is raised in a given year. So the whole thing about tax transparency is it should be a positive sum game for all parties. This isn't just about civil society calling governments to account. It's about how governments themselves can gain advantages from engaging in some of these processes and actually get their hands on more revenue, fund better public services, and enjoy greater political popularity and legitimacy. So there are multiple interests in enhancing tax transparency. It's not a one-sided equation. The video series is good at setting that out and explaining those steps and the rationales and logics that underpin that.
In talking about the wealthy and tax loopholes and write-offs that help them avoid paying their fair share of taxes that can lead to inequities and a loss of revenue for public services, how do you address this in the course?
Principle 12 encourages governments to conduct a systematic cost-benefit analysis of systems of reliefs, exemptions, and allowances. And this is covered in part in the videos, but it's also covered in the principles themselves. Are individual reliefs and allowances doing what they were intended to do? Are they having unintended consequences and costs, or are they delivering on the intended benefits? And what evidence for that is there? So it's not saying reliefs and exemptions are bad. It's saying assess them to see what they're doing. Put this information in the public domain so that can be debated fully. Ultimately, every country will choose and develop its own systems of reliefs. There's no right or wrong answers on that. But you want the choices and decisions reached to be as fully informed as possible. Now, maybe we're reaching a bit of a turning point here, because it's not just us saying this, and it's not just the GIFT principles on tax transparency that are making this claim. One of the developments at the recent Finance for Development conference in Seville was that a coalition formed calling for more evaluation of so-called tax expenditures. That comprised the Institute of Development Studies, the Council on Economic Policy, the International Centre for Development, the German Institute for Development, the Institute for Development and Sustainability. And what they say is that 4% of global GDP is accounted for by tax exemptions and reliefs, which is quite an incredible figure. It would also be 25% of all tax revenues collected globally that is basically given away. And they say this huge sum of money is unreported, untracked, underevaluated. We agree. The principles and the videos make that argument. And the key point is that the international community does have a set of international best practice principles it could use to lever for a call to do something about that in the form of Principle 12 in the GIFT principles.
What are the most important tools or ideas that you hope people will take from this course?
What I hope people take away is that the principles are useful. They could be applied in your country. They could help you to arrive at a better tax system. And if many of the forms of valuation identified in the video series and talked about and in the principles are attempted and implemented, countries can work out through collaborative societal dialogue how they can achieve evidence-based targeted reforms to improve their tax systems. If you can get those ideas circulating, then we move closer to the idea of having greater degrees of assessment and evaluation in tax systems so we can achieve improvements. And that is the biggest idea in the videos and behind the idea of tax transparency. The other big idea is that tax is far more important an instrument than just being about revenue raising. It does all of these other kinds of things. It can potentially shape economies. It can shape inclusion. It can enhance economic management. It can enhance the macroeconomic governance of the economy. We've already talked about how it can be integrated into budgetary processes to improve public financial management more generally. All of those things are really important, but you have to build good tax governance systems, and transparency is the key to that.
In my mind, there are two really big takeaways from this whole course. Somebody who walks away at the end of following all these videos should have two really big ideas in their mind. One is that the tax system is a bigger picture than they imagined when they arrived. In other words, this is something that you have to view as part of a greater system. And the second idea that they have to take away is that a good society has a good tax system. And that's fundamental, because there isn't such a thing as a good society without a good tax system, because quite simply, there'll be too much stress in it. And therefore, we have to achieve that goal, because for the benefit of everybody, tax has to work.